All right. We are recording right now. So, this class is being recorded for the makeup of July 4th, 2016. It is now Thursday, July 7th, and the class is being recorded for those that are unable to join with us live at this time. To start, I will have a recap of last week. And before I do that, I ask you all the participants if you have any questions about the material we covered last week or the homework.
No, sir.
Nope.
All right, well, let me ask you some questions. Accounting is often referred to as the language of business. Does this statement make sense? Why or why not?
It does make sense because it gives you a true picture of all the transactions and the daily activity of a business, and it's the language tells you how the business is doing, much like talking to somebody.
I agree with that. I also think that it helps in the fact that you can kind of figure out where your business is going, so you can kind of see what trends you should get on and things like that.
Accounting, I think, a lot like statistics. Again, if you have any for a statistics course, you'll hear me say it tells a story. It's numbers telling a story. To the uninformed person, if I say the number 4, it simply just means the number between 3 and 5.
Mm-hmm.
However, if I put something in front of that, such as standard deviation or net income, and we apply the 4, it takes on a more meaningful interpretation. At that point, we can interpret, is 4 good or bad? Is 4, knowing how it's applied, is it good or bad for our organization? Accounting is going to tell that same story through monetary terms. Again, it's going to tell how solvent is an organization. Is an organization profitable? Is an organization on track to reach its goals? Or is it falling further behind? Is it near the term of bankruptcy? Or is it in a position that it can return money to shareholders? If you are a creditor, should you loan money? If you're on the debit side, should you invest money?
Mm-hmm.
All of these are stories that can be told through accounting. All right. In interpreting this, tell me, what are the 4 financial statements?
Oh, looking at my notes.
Income statement, balance sheet.
Income statement. Did I hear balance sheet?
Yeah.
Yep.
Help me out, Taylor.
I'm getting there, I promise.
Cash flow statement.
Statement of cash flows. Refer back to the last presentation if needed.
The statement of retained earnings.
Statement of retained earnings. Statement of retained. All right. Tell me, what does the income statement What story does it tell?
The revenues and expenses.
Revenues and expenses. The balance sheet.
Balance sheet is more transactions. It's broken down into the assets equals liabilities plus equity.
That fundamental equation, assets equal to liabilities plus owner's equity. The balance sheet is often referred to as a statement of financial position. It's going to tell us exactly what we own and have used to. What's an asset? Something that we own, something that has an intended purpose to deliver us some form of gain. Most likely that gain being represented as income. Liabilities represents those claims against the assets, things that we own. And what do we mean by owner's equity?
Owner's equity is more with shareholders, like with dividends and things like that. As far as like issuing stocks, revenues, and then also expenses are kind of balanced out in that aspect too.
Okay, owners. It's going to be the owner's claim on those assets. Our assets are on the left of the equation. To the right, remember, our creditors' claims are represented by liabilities. Our owner's claims are represented by the owner's equity. So these are the claims against those assets.
Mm-hmm.
Statements of cash flows.
Tells you where your cash is going out.
Mm-hmm.
It's going to be the statement that shows us inflows and outflows of all cash coming through the organization. Those cash flows are going to come from financing activities, operating activities, items that we do that generate cash flow. Finally, we have the statement of retained earnings. How might you describe that?
How much revenue, or how much you.
Mm-hmm.
How might you describe retained earnings?
It's with the net income and dividends involved. So more so, it kind of shows like what you're paying your shareholders as far as what you're bringing in, kind of balancing that out.
I would interpret it more net income minus your dividends. Remember that net income, that's the income that's available to shareholders. One way that we can return that to our shareholders are through dividend payments. What we do not return to shareholders, though, is the balance that is retained inside the company. That would be your statement of retained earnings.
Okay.
If I had net income of $1 and I spend $5 back in the form of a dividend, I now have 95 cents of retained earnings. That is money that was available to shareholders, that was not distributed to them. It was above and beyond the dividend, and it was money that was retained inside the organization.
Say that again. Repeat that, please.
Income that was available to the shareholders that was above and beyond the amount that was distributed in the form of dividends, and it was retained inside the company. All right, last question I was going to ask is, what is the accounting equation? And we've answered this up here. Assets equals liabilities plus owner's equity. All right, now let's think about this. What business activities are going to be represented through this equation?
As far as like the transactions, or
Now for equipment, inventory?
Inventory. Well, think about 3 activities that an organization, we mentioned on 2 of these up here. Okay, how does a company bring in cash? What originates cash flow inside an organization?
Sales.
Sales, or through some form of operations.
Yep.
Someone call this operating.
Oh, and then investing and financing.
Investing and financing. So through some form of operations, we are going to take in income. We are going to use these assets to generate income through operations. Let's look at it from the liability standpoint in the form of financing. If we need to raise additional capital and we look to do so, taking advantage of through a bond market or a long-term debt market, borrowing money, we could create liabilities by financing debt. Thirdly, we have investing. If we are using available cash toward acquiring certain assets, if those assets were deemed as an investment, investable assets, those could be represented up here. If these retained earnings were held on and distributed toward an investment, again, we could say that those would be through investing activities. So the statement of cash flows is going to show income, or excuse me, going to show cash coming in and out of an organization through operating, financing, and investing activities. Good job. All right, do we have any questions about the homework?
Last week's homework?
Last week's homework. Taylor, do you have anything to add from chapter 1? Add or add?
The only thing I kind of had a problem with was like filling out the statements, but I went on NetTutor for that and kind of got my answers that way.
Okay.
Like on the cereal problem, I didn't understand why I got 73 grand for common stock, where that came from. I got all the other answers right.
All right, how did you arrive at net income?
For the cereal problem?
Just in general, how do we arrive at net income? Revenue minus expenses.
Mm-hmm.
Just make sure that you have those items properly characterized as in revenue. And again,
Okay.
you're backing out all the expenses. If you're,
Yeah, I just had a couple of things I had to tweak, and that was it.
okay.
Yeah, like I was putting expenses as negative, which putting it as positive, but underneath the expenses ended up getting it right.
Well, the net income would be, expenses would be subtracted from revenue.
Yeah, in the serial like in the balance sheet in the serial problem, I was putting it negative like under the expenses, and I was getting it wrong.
Okay.
But on NetTutor, she said it had to be positive, like knowing it's an expense, you have to subtract it anyway. Basically, I was making it like a positive in a weird way.
A double negative.
Yeah, double negative. Yeah. But other than
So your question was more of formatting inside rather than the concept of net income.
yeah, I understood like where things went just fine. But I haven't done one of these in a good, 3-ish years. So I was a little rusty.
The most important thing from my perspective is you can answer those questions that I just asked. Okay?
Perfect.
If you do have questions about coding or specific formatting inside one of these programs, just reach out to me outside of the class.
Okay.
Taylor, can you see my screen?
Yes, I can.
Okay. Chapter 2, we're going to focus on accounting for business transactions. So again, we're going to take a look at some specific transactions that might occur inside an organization and how you as members of an accounting department would properly allocate and record these transactions. All right, analyzing and posting. The accounting process identifies business transactions and events, analyzes and records their effects, and summarizes and presents information in reports and financial statements. Okay, look at the flow down at the bottom. Now, I realize I just made the screen easier, but I want to point out to you that all of my notes are found in the bottom of the presentations. Okay, I know that you'll have these available to you. All right, so you're going to begin the accounting process by analyzing source documents. For example, when you go and pay a bill, it's typically that vendor gives you a receipt. When you receive that receipt, that is going to be your source document of what you're going to record from. You're going to record that inside the journal. Now just think of the term journaling as your first step. All right, your journal is going to be arranged in chronological order based upon date. And at the end of the accounting period, those are going to be, your journal entries are going to be brought over. That process of bringing over we call posting. Those are going to be posted into what we call a ledger. Once all transactions have been posted, you're going to prepare what's called a trial balance. And the purpose of the trial balance is to make sure that all information has been transferred properly. And it is a listing of all account balances. Have you all looked at a general journal, a ledger, or a trial balance before coming in here?
Yeah.
Yes.
Okay. Good. All right, what do we have going on here? The point I want to make is to ensure that all sales are rung up on the register. Most sellers require to have their receipts in order to exchange or return items. Now think about the last time you ever went in and returned an item. something that you have purchased and you take it in to exchange it, it's usually required that a receipt be produced in order to exchange.
Mm-hmm.
Reason that is again, looking at that source document. When that receipt is processed and that exchange is processed and you're giving your money back, think about it from the retailer. When you walk in, let's pick on Home Depot. When you walk in Home Depot and you purchase, it's grilling season, you purchase a grill. What transactions do Home Depot, what do they record? What's going on with them?
Am I paying cash?
Let's pay cash.
Okay, let's pay cash.
We're paying cash for it.
All right, so cash goes up for them.
Well, think about it this way. First thing, the grill goes out the door.
So let the inventory go.
That's an asset out the door.
Yep.
Okay.
Now they take in cash.
So their asset goes up.
So the asset goes up. In that transaction, they just exchanged that. Remember, our equation still balances because an asset went out, cash of equal value, also cash being an asset of equal value comes in, we create a wash. Now, when you bring that, where does that cash, which other statements will that affect?
Your cash.
The income statement,
It would show up in the income statement
the balance sheet.
as revenue. It would be reflected under the balance sheet because, again, you're dealing with assets. And it would also show up under the statement of cash flows. It would be through operating activities. So when that exchange is processed and that's put back through, we go back through and we're reversing everything else. But again, that receipt is going to be used, again, through the source document. All right, an account is a record of increases and decreases inside of specific assets, liability or equity, revenue or expenses. So when I talk about an account, just remember I'm talking about a record of increasing or decreasing any one of these items. And the general ledger is a record containing all accounts used by the company. All right, so let's recall. Assets are equal to what?
Liability plus owner equity.
Liabilities plus owner's equity. Again, what do we call assets? How do we define assets?
Things of value.
Resources owned or controlled by a company and that have expected future benefits. All right, now I'm going to say most accounting systems that we see today have separate accounts for all of the different assets. For instance, cash. You would have an account tracking cash.
Yeah.
Accounts receivable. Notes receivable and any prepaid items. Each one of those would have their own separate account. Liabilities, we say, are claims against those assets, creditors' claims against those assets. Okay, again, you're going to have an account that's going to track each one of these liabilities. And equity accounts represent shareholders' claim on those assets. It's often said that equity is the owner's residual interest in the assets of a business after deducting liabilities. Remember, it's the owner's claim on the assets. Here's all going to be examples of particular assets. Cash, accounts receivable, notes receivable, prepaid accounts, supplies, equipment, building and land. All right, remember, asset accounts are resources owned or controlled by a company. And those resources have expected future benefits. Most accounting systems include separate accounts for each of the assets. All right, look at the points I make here. Customers and others who owe a company are often called its debtors.
They're called what? Oh, debtors. Okay.
A college parking fee is a prepaid account from a student's standpoint. At the beginning of a term, it represents an asset entitling a student to park. The benefits of the parking expire at the end of the term. So from the student's perspective, that parking pass was an asset. Okay, I want to point the term prepaid. So again, when we see the word prepaid, these are accounts that apply to the current or some future period. These assets must be adjusted at the end of each period to reflect what asset value remains on them. Think about this. You pay $100 for a prepaid parking permit that entitles you to park at your local campus here for a period of 1 year. Now, that is an asset to you. At the end of the first quarter, what's the value of it?
How much was it, $100? So it's like
$75.
Right.
So you would want to adjust the value of that asset to show that you're carrying a $75 asset, not just a $100 asset.
So how do you do that?
The question, how do we do that?
How do we do that?
You would just record it under the new value. You recognize that that asset is no longer worth $100. You have used up 1/4 of its value. Now, some assets are described as intangible. What's an intangible asset?
Oh, crap.
Coca-Cola says it recently shows $1 billion in intangible assets.
Future sales?
Well, if I say something's intangible, what does that mean?
Not having a physical presence, unable to be touched.
Does not have a physical presence, cannot be touched. Taylor, do you work with auto dealerships? Is that correct?
Yes, I do.
Okay. When I throw out some of these car names, I want you to tell me what comes to mind.
Okay.
Ford Motor.
Oh, man. More problems that I've listened to.
Okay. Volvo.
Barely existent.
What's a Volvo known for, though?
Honestly, I know like 3 people that have Volvos. I work a lot with Toyota.
Okay. Toyota, what's it known for?
The reliability and gas mileage, or they never die.
Reliability or gas mileage. A friend of mine, his dad has one that has about 700,000 miles on it.
Yep.
We're talking about Volvo, though. Volvos are known for safety.
Okay.
Volvo's built their reputation on safety. All right, now I remember a client of mine one time complaining that his Volvo was slower than the Nissan Maxima that he had prior to that. To which case I showed him, though, how much more that Volvo weighed than that Maxima. That Volvo was built to sustain a crash test. Volvos are known for safety. Mercedes-Benz,
Luxury.
luxury. BMW, the ultimate driving machine.
Yep.
All of those could be intangible assets. It's the reputation that is known. People are willing to go and pay a premium price for a Volvo, a Mercedes-Benz, a BMW. Will a Mercedes, like a Ford, get you from point A to B?
Yeah.
Yes. But there's that perceived luxury status. There is that perceived safety, that perceived ultimate driving machine that people are willing to pay for. That would be a good intangible asset. A good intangible asset that we are seeing in today's marketplace might even involve intellectual property. So again, if you are a technology firm and you're employing software engineers or software developers who might have all of this intellectual knowledge up in their head that has yet to become out onto paper, okay, but again, that knowledge is expected to produce some type of future economic benefit. Again, that could be intellectual property. You know, right now, Google, for instance, is investing a lot in this AI, artificial intelligence movement that's going on. And again, a lot of that is something that you cannot just come up and place your finger on. But again, it does have value. Liability accounts. Tell me about liability accounts.
Accounts payable, liability.
All right, accounts payable is a liability, which brings me to my first point. Pay attention to the word payable. Okay, when you hear the word payable, it is going to indicate that you are dealing with a liability. Also, the word unearned. And when you hear the word unearned, you know that you're meaning a liability that is yet to be fulfilled. You owe it. You have yet to earn it. So again, when you hear the word unearned, you're most likely going to be dealing with a liability. And a good example of this is, think of a subscription. All right, if I pay for a newspaper subscription for 1 year and they allow me to cancel that at any time and receive a refund of a prorated refund, once I start that paper and I pay for it, if it's $1 a day and I send $365 to my local publisher, okay, that is an unearned revenue. If they have yet to deliver me my first paper, yes, they received money in, but they have not earned that. And remember this concept we introduced last week called revenue recognition. It says we recognize it when it's earned. So this is an unearned revenue that has not yet been earned. Once I cancel that, if I did cancel that after the 1 year mark, or excuse me, at the midpoint, they still have to refund me. So they wouldn't want to recognize it as earned because there's a liability that they might in the future owe that back. And equity accounts. Okay, as we identified some of these, dividends, common stock, revenues, and expenses are all your equity accounts. Sometimes we are going to call the dividend account a Contra equity account because it reduces the normal balance of equity. It's equity in the account, but it reduces it because we pay it out. Okay, if we do pay it out, remember, we are pulling equity out of the company and returning it to shareholders. And that dividend is the withdrawal of assets by the owners. Again, through dividend payments, we are distributing assets from the corporation to the owners. Now, I would encourage you to look at any possible investments you might hold, such as through your retirement account, if you have a retirement account at work or a personal retirement account or any type of investable account that owns individual stocks or mutual funds, take a look at some of the monthly activity that occurs, and you might see certain transactions called dividend payments being paid into your account. Again, you are owners in those companies that you are invested in. So again, when you receive those dividends, you are taking earnings, you are taking available assets and returning them to you. All right, so here we are. Revenues. We bring in revenues. What do we do to equity?
Equity goes up.
I want to say we increase it.
We increase it, and if we pay an expense, we
Decrease it.
Good job. All right, let's look at this need to know slide. Classify each of the following as an asset, a liability, or owner's equity. Prepaid rent.
That's going to be a liability.
It's an asset.
No, it's an asset.
It's an asset.
Prepaid.
Prepaid is asset.
You have prepaid it. Remember, when you see the word prepaid, you are most likely dealing with an asset. Common stock.
Equity.
Notes receivable.
Liability.
Notes receivable is asset, isn't it? Because you're receiving the money, not paying it.
You say notes payable or receivable?
Notes receivable.
Notes receivable. Again, when you see the word receivable, know that you are most likely dealing with an asset. I'm using the word most likely because, again, being with quantitative mind, it's rarely that we like to use us math or science-minded individuals don't like to use the word definitely unless it has been proven over and over through laws. But I can tell you for this class, it can be your own law that when you see the word prepaid or you see the word receivable, you are dealing with an asset. Accounts payable.
That's a liability.
It's a liability. Again, when you see the word payable, you are, for the safety of this class, going to be looking at liabilities. All right, accounts receivable, we see that word receivable, so it's an asset. Equipment.
Asset.
Asset.
Asset. Interest payable.
Asset.
Asset. Unearned revenue.
Unearned revenue. Right here. Liability.
Liability. Look at that keyword unearned. Again, when you see the word unearned, you are going to be referring to in this class a liability.
Go back to interest payable. What was interest payable?
Interest payable.
That's an asset.
It's liability.
Wait a minute.
Liability.
Yeah, liability.
Because it's a payable. Okay.
Right.
Again, seeking that word payable.
Okay.
And prepaid insurance.
Asset. Asset.
Yeah, it's an asset.
Again, the word prepayable.
That is really zoomed in.
Yeah. I'm trying to get my screen. I'm trying to get this up to my screen.
The PowerPoint again?
No, I'm going to show you a summary up on my board.
Oh.
Again, I want to pay attention to these key words. When you see the word receivable, we're talking about an asset. The words prepaid, we're referring to an asset. When we see the words payable and unearned, we will be talking about liabilities. We are entitled to some future economic use. We are obligated for some current or future liability. Again, why we use the word unearned. All right, let's look at a ledger. And how do we define a ledger?
Collection of all the accounts.
Yep.
It's a collection of all the accounts. And give me some names of some particular accounts that we might find.
Equipment.
Equipment.
Cash.
Cash. Remember, we would most likely have one for each asset and each liability. We're going to have one for each. Started to say account, but we're going to have an account of each individual asset, liability, and equity. Each individual component of what we define in that accounting equation. All right, T accounts. I will have to suggest that in doing the homework, be sure that you set up in the beginning, once we go through a couple of these exercises, this is going to ring true to you. You want to set up and use these T accounts. They're really good with just jotting something down, helping formulate a thought process, and actually seeing your thoughts on paper. All right, so a T account is going to represent a ledger account and is a tool to understand the effects of one or more transactions. Now, to set up our T account, we'll look up at the top. We're going to have an account title. The left side is always going to be debits. And the right side is always going to be credits. All right, think about this. The terminology comes from a time when first double entry systems were developed. We still use this in terms today. All right, just remember, debits are always going to be on the left side, credits are always on the right side. So, point to make, assets are always on the left side of the equation. And thus, if we want to increase an asset, we debit it. And liabilities and equities are going to be on the right side. So if we credit it, we are going to increase it on the right side. Like I said, if you had looked at these before coming in here, it might make a lot more sense. Here we have our double entry accounting system. Here we have our basic accounting equation. I want you to look and pay attention to this slide. Assets. If we debit, here's individual T accounts. If we have our, let's identify names up here. Where you see in that first T account, assets, let's just call that cash. If I wanted to increase cash, if I had a transaction that increased cash, remember, I would record that on the left side. If I wanted to decrease that asset, I would credit it on the right side.
Taylor?
Yeah.
When I was going through the homework,
Yeah.
the second part of it, I had this written down right in front of me on a piece of paper, and the pluses and the minuses, and it really helped.
Yeah, I'm jotting it down right now too.
It really helped me out because I was really lost, but it helped.
Yeah, I'm jotting it down
Right in front of me.
Liabilities. How are we going to decrease the liability?
You're going to debit left side.
We would debit it on the left side. And what if we wanted to increase it?
You wanted to put it on the left side.
So if we credit on the right side, we are increasing, right?
We debit on the right. Yeah.
Now with the equity portion, what am I going to do if I debit on the left side?
We're going to decrease.
I'm going to decrease, just like a liability. And if I want to increase it, I would credit it along the right side. I do suggest that when doing the homework, you copy this slide and have it in front of you. You've already heard testimony. It does make it a little bit easier. All right, here would be an expanded version of that accounting equation. Again, picking up with revenues and expenses over on the left side. So again, debit for decreases, credit for increases. For expenses, debit for increases, credit for decreases. Remember, this is an expanded equation. Common stock minus dividends plus revenues minus expenses. All of that's going to be represented by the equity portion of that basic equation. All right, so let's look at one. An account balance is the difference between the increases and decreases. So when we balance it, again, we're going to net the difference between our increases and decreases. That's going to give us the current balance of each account. All right, as an example, if we receive $30,000 investment for an owner in stock, why is that on the left side? This is a basic T account for cash.
Because it's an asset and it's increased.
It's an asset and it just increased. We took in $30,000 of cash. That cash is an asset. Again, if we took in $4,200 consulting services revenue, again, that's an asset. We decrease it. Collection of a receivable. We collected cash. Again, we want to increase it. Now, on the right side, these are all purchases or payments that we have made. These are all represented by decreases to cash. So this is actually cash that went out the door. So if you took all along the left side, 30,000, add in 4,200, add in 1,900, do that for me and tell me what you get.
What did we add again? I can't see that. 4,200, 1,900.
36,100.
36,100. Now, what are our liabilities equal to?
$31,900.
31,300.
And if I take 31,300 from 36,100, what do I get?
4,800.
4,800. Note that that 4,800 is a positive balance. Therefore, it's going to be recorded on the left side. And I'll point out we do not use plus or minus signs when we're looking at ending balances.
Depending on what side.
I know it's on the left-hand side, therefore I know that it is a positive balance. All right, let's look at a little summary. All right, identify the normal balance. Are we going to debit or credit here for each of the following accounts?
You're going to debit the first.
We are going to debit the first because it is a
asset.
It is an asset.
And it increases.
All right, we are going to credit common stock. Again, you see the summary right here. All right, now, let's look at posting some transactions. So remember, the first step, we're journaling. Now we want to take a summary of all these journal entries and bring them over to a ledger. All right, so if you're taking your T accounts, look how along the left-hand side we put these in chronological order by the date. Now we've got a double entry system here. So in that first example, we received $30,000 as an initial investment. All right, so the first line we show on December 1st, cash. We debit that for $30,000. Now remember, we've got to balance that equation. So what would be the double entry we would use to balance that?
The common stock.
We are going to transfer equity out to that individual in exchange for $30,000. Now I will just point out how the debits are always going to go up on the first line.
That's key. Okay.
And the credit, but in addition to being on the other line, just note how it's indented just a bit. That's simply done as a way of, if I was scanning down that report, I could quickly identify that, hey, this is a new entry. And again, that's going to remain in balance. You'll see on the third line, it's often that you will find a written explanation of what actually went on. This can be in your own words, usually abbreviated, but yet clear to the person that this is intended for. So I know that that $30,000 was received investment by the owner. What do you notice here?
It's not debiting and credit. Well, it kind of is, but not as detailed as it was in the last slide.
Here's what you would more likely see in practice. This is an example of one. You're right, it's consolidated. I still have my debits and credits, but I don't have that written explanation. I can have that written explanation if I want to here. I mean, note my point. It's typically included in ledger accounts, but usually only for unusual events. All right, now what we see here is when we're going to post these transactions. In practice, you're going to find most of this is done through computer systems. Those computer systems are usually, I realize this is small, but the computer system is usually going to have some type of code that's going to identify debits and credits. So if we look right,
I think she said we would hear some things in the background.
That's my bad. I'm really sorry.
no, I thought it sounded like it was on our side.
No, it's my work going off. We communicate through Skype, so.
Hopefully they're not blowing their top.
I'm logged out. That's all right.
All right, what I was gonna say is usually you would see the abbreviations DR for debit, CR for credit. With accounting, with computerized systems, posting is usually done automatic. I mean, almost think of your own personal bank accounts.
Mm-hmm.
Once that's cleared, I mean, it's automatically posted online for you to view. A journal is often referred to as a book of original entry. Okay, it's the original entry. Remember, it is the first place that you're going to record the transaction. The ledger is often the book of final entry because from the ledger, so remember, we first post to the journal. We then consolidate the journal to the ledger. We then take the information from the ledger and prepare our financial statements. All right. We're going to take a look now at some specific transactions. So we're going to start looking at some examples of analyzing transactions. So exactly what would we do under specific events and how we would record. Okay, here we are. We identified that we received $30,000 of cash in exchange from Chaz Taylor. So Chaz is going to come in and exchange $30,000 of cash for $30,000 of common stock. That common stock, we're transferring equity. Remember, we're pulling equity out of the company and we're giving it to Chaz in exchange for this cash. So step one, identify the transaction, and that is what we just did. Step two, analyze it. Again, applying that basic equation, assets equal liabilities plus owner's equity. We are going to show an increase of $30,000 of cash. Zero liabilities, $30,000 of equity. Is our equation in balance?
Yes.
Yes. Next, we are going to record that transaction.
Okay.
Okay, we would put the date. Here it's just noted transaction 1. Cash. $30,000. It is debited. We want to increase that. Common stock. What are we decreasing or
Increasing?
We're increasing it.
We are what?
Increasing.
Credit.
Crediting.
So
right.
we want to exchange it out. What's step 4?
Then you post it.
And then we are going to post it. Does that look like a T account?
Mm-hmm.
Yes. So we see we have the T account for cash and we have the T account for common stock. Transaction number 2. Purchase supplies for cash.
Okay.
So we're going to go out and purchase $2,500 worth of supplies, and we pay for that through cash.
So you're going to debit the cash and credit supplies.
Well, in step one, step two, what do we have going on? Always apply it to that first equation just to make sure you're in balance. So we are going to decrease cash or an asset for $2,500 and increase supplies, an asset for $2,500. This is an example of exchanging an asset of equal value. Again, our equation is still balanced. It would actually be recorded 0 equals 0 plus 0.
Okay.
All right, so to record this, first, we want to debit supplies. Why do we debit?
To increase the asset.
Yep.
We want to increase our asset. And we are crediting cash for what reason?
Because that's how you paid for it.
We want to decrease it, take it out.
We want to decrease it.
Okay.
So to decrease an asset, we must credit it.
Yep.
Transaction 3, purchased equipment for cash. Similar example. Fast Forward pays $26,000 cash for equipment. Let's analyze. Is our equation in balance?
Yes.
Yes. How are we going to record it?
You debit equipment 26 grand and credit cash 26,000.
And finally, how are we going to post?
So you do the same thing.
Post the equipment T account and the cash account T account.
So we are posting it to.
So when it says PR in between like equipment and debit and cash or debit and credit, is the PR the numbers like just the account that it goes to?
Yes, I believe it's just the number of the account.
Okay, just double checking.
Yeah, you'll see a slide. You'll see some reference that I placed on that. I'm not going to put a big reference. Again, we're looking at computerized systems here. I didn't spend a lot of time on that because, again, but note that that is, think of it as an identifier.
Okay.
All right, now I'm going to try something unique. I realize it's easy to do these sometimes when you're looking at them. So get out a piece of paper.
Okay.
And I'm going to give us some examples. And we're going to go through this without having a slide to front us. Okay, transaction number 4. Did everyone jot this down?
Yeah, I'm doing that right now.
So that we have something to refer to. Okay, transaction number 4. We are going to purchase supplies on credit. Fast forward purchases, $7,100 of supplies on credit from a supplier. So what do we do? Step 1. Identify. Fast forward, purchased, 7,100. Supplies on credit.
Okay, so it's credit, which means it's
Step 2, we analyze. All right, what's going on here? What's the asset being affected?
Supplies.
the supplies is being credited.
Being debited.
Well, first, remember, we're going to use plus and minus signs in the first. So what are we doing?
Okay.
You're adding to supplies.
We are adding to supplies. Do we have a liability being affected?
Yes.
What might we call that?
Accounts payable.
Accounts payable. And do I want to add or subtract accounts payable?
Add.
Yeah.
I want to add. Owner's equity being impacted?
No.
All right, step 3. We want to record. Okay, so here we have transaction 4. What goes on my first line?
Your debit for supplies.
Supplies, debited what?
7,100.
7,100. What is my double entry here?
Accounts payable.
Accounts payable, 7,100. Step 4 is going to be to post. Now, I want to make sure I'm showing this on the board.
Yeah, I can see all of that.
So step 4 is that we post. What am I posting to here?
You're gonna post to supplies, but it's gonna be underneath assets, right? Or is that
We get a T account for supplies
okay?
and 7,100. Now, from a previous transaction, we had supplies of 2,100. One of the other three transactions we looked at. What other T account am I going to have?
The accounts payable
The accounts payable
for credit.
for credit of
7,100.
7,100.
Okay, so when you're setting this up, you want it to, even though supplies is an asset, you want it to be a specific account underneath the asset, like cash or in this case supplies.
You will have an account for each individual asset, correct?
Okay.
Otherwise, once you posted that, once that came over to and we started recording financial statements off, it'd be impossible to record financial statements.
Yeah.
We would only see an increase or decrease of assets, but I wouldn't see specifically what assets was.
Okay. So this is more detailed. Okay.
All right, transaction number 5. provide services for cash. Fast Forward provides consulting services and immediately collects $4,200. So I'm just going to put Fast Forward consults and receives $4,200 cash immediately. How can I analyze this?
Okay, so you're going to credit the cash account because you immediately received it.
So I'm going to credit cash for $4,200.
Mm-hmm.
You're not going to debit it?
No, because you're gaining.
Yeah, now I'm not recorded it yet. Right now I'm just
Okay.
showing that we are
Okay.
increasing cash by $4,200.
Okay. Okay. Okay.
Are any liabilities impacted?
No.
No.
And you're going to increase the owner's equity because it's revenue.
Good job. And I'm going to just call this consulting revenue.
No, Poochie.
Okay, how do I record this?
Honey. No.
On the first line, you're going to have cash debited for $4,200.
Oh, jeez. Yes.
So this is going to be transaction number 5. And what did we say we were going to?
We're going to debit it $4,200.
We're going to debit cash $4,200 and consulting revenue.
Going to credit that for $4,200.
We're going to credit it for $4,200. We're then going to post that to our T accounts, and we would have T accounts for cash and consulting revenue. All right, now I'm going to look at just a couple more examples, and we'll start this. Is this a little clearer to you after coming in here?
It is for me, yeah. Yeah.
All right, you're going to do this one on your own. Charlie just invested $4,000 in cash in the Tata company in exchange for common stock. So I just identified for you. How would I analyze this? Next, tell me how I would record. And finally, what am I going to post to?
You said 4,000, right?
$4,000.
Okay, just make
I
sure.
invest $4,000 in the Tata company in exchange for cash.
You're increasing assets, $4,000. And owner equity, common stock for $4,000.
Am I debiting or crediting?
You're crediting.
Am I positive or negative? Am I
You're
increasing?
positive.
You're going to be positive on that.
Positive here.
Mm-hmm.
Then when I would record this to my journal, we're going to say that on January, let's just keep it simple. On January 1, what's happening?
You're gonna debit your cash, $4,000, and credit your owner's equity.
So January 1, cash, and the owner's equity. Remember, I'm getting stock out of it, so common stock, and we are showing a positive balance up here, so would I debit or credit down here?
Credit.
You're gonna credit that.
$4,000, and I gotta show my debit there. What T accounts would I post to?
A cash account.
A cash account and a common stock account.
Common stock.
All right, now on, you know what? Running out of room down here. All right, so on January 5th, the company purchases $2,000. So I'm going to take this money and I'm going to purchase $2,000 worth of equipment on credit. So I just identified, how would I analyze? There's that basic equation. What assets are impacted?
Equipment.
Equipment. So first we'd have an asset of equipment that we choose to increase. To increase an asset, what do?
Debit.
We debit. And we have a liability that's being affected.
So that's an increase.
We purchased $2,000 of equipment on credit.
Accounts payable.
Accounts payable. Now, do I want to increase or decrease accounts payable?
Increase.
You want to increase it?
So do I add or subtract to increase the liability?
You want to add?
You would add. Okay. So what am I going to record here?
Equipment, debit 2,000.
Equipment, debit for 2,000.
And accounts payable, credit for 2,000.
Accounts payable for 2,000. On January 14th, the company provided $540 of services for a client on credit. We provide $540 worth of services on credit. Have we been paid for it yet?
No.
No.
No. Have we earned it?
Yes.
Yes.
Yes. Okay. Do we have an asset being affected?
Yes. Accounts receivable.
Yes. Accounts receivable. Do I want to debit or credit accounts receivable?
Debit.
I want to increase it, so I would debit. Now remember, what's my double entry that's going to keep me in balance?
I don't know what the name of the account would be.
Give me the
The
basic
revenue
term.
service, revenue, services provided, consulting.
I call it service revenue.
Service revenue.
So it would be a revenue. And do I want to debit or credit this?
You're gonna credit it.
I want to credit it.
Equity.
Because it's equity, I credit it to
Because it's
increase it. I think you all have this, the transaction piece down. Do you have any questions?
I do not know.
All right, 2 more concepts I want to touch on before we wrap up. What's a trial balance?
Trial balance is before any, basically like making sure all of the transactions have been switched over and been posted correctly.
Want to make sure that they've been posted correctly. All right, how are we going to prepare a trial balance?
You can do your assets equals liability.
Again, you always want to make sure you can apply that
Balance.
first question. All right, step 1, when you are to prepare the trial balances, you want to list each account title. And you want to take each account and put it inside the trial balance. If your balance is 0, list it with a 0 balance. Record that 0 balance always on the normal side. Step 2, compute total debit balances. So you want to total up all your debits. You want to total up all your credits. You're going to look down at the bottom in step 3 and identify whether or not everything's been posted correctly, because you should equal, your debits should be in equal of your credits. All right, so to take fast forward, so remember you're going to have, we'll call it fast forwards trial balance. There is a slide for you in here that is going to show you what this looks like. What I want to point out, you always, in any of your statements that you are going to make, or you are going to prepare, the company's name is always going to go up at the top. Usually that will be centered in the page. The next is going to be the report or statement that you are preparing. What did you put under that?
The dates.
The date.
Regarding the dates regarding the transactions.
I'm just going to call that December 31st, 2015. Now you are going to have each of your accounts are going to have a line entry. I'm going to list 3 common assets. I have cash, accounts receivable, and equipment. However, what order are those listed in?
Assets to liabilities to owner's equity.
Correct. Assets are always going to be on the top, but why do I have cash first, followed by accounts receivable, then equipment?
Most liquidable?
Most liquidable. Good job. Always based on liquidity. You'll notice this same formatting on your balance sheet. Cash is our most liquid asset, followed by accounts receivable. Equipment is our least liquidable asset. Therefore, it's going to be down here at the bottom. You want to list your accounts receivable, or excuse me, your liabilities next, but using that same order. So accounts payable, and we have unearned revenue. Our accounts payable was the only liability that we looked at. But again, when you were listing your liabilities, you will list those in order of liquidity. What liabilities are due first? Okay, those obligations that we must meet first, we are going to put those at the top. The ones that we have deferred out a longer period, we can push those further back. They are going to appear under the more liquid cousins. Next, we look at owner's equity. And we had unearned revenue, common stock, dividends, rental revenue. I'm giving you some examples. You're going to have your expenses, your revenues, your dividends, and your equity. All of those are going to be in your common stock, your dividends, your revenues, and expenses. I just expanded that equation for owner's equity. All right, so you're going to put revenues and expenses. And you're going to put balances each one of these are going to have a line entry and a corresponding value. And then you come down here at the bottom and you sum your debits and your credits, and your two should equal. If it does equal, you are in balance and therefore ready to start preparing your financial statements. If you find that this is not in balance, we want to go back and review and try to find out and identify where we skewed off course. Now, if this doesn't appear to be in balance, I want to share with you 6 key areas to start looking at to start that investigation. Step 1, the first place I would look is to make sure I have summed these columns correctly. You could have put in the correct data, but incorrectly summed the data, therefore giving you off-balance numbers. So make sure you correctly add. Number 2, make sure that you transferred the correct balance. A lot of this is going to explain. Now, I'm going to say you doing this right now, you're doing it by hand. I would say computers, again, using a computerized system, this is all going to just occur. Step 3, make sure that you did, if you summed correctly and you've added the right numbers in, so you transferred the right numbers, make sure you correctly identified each line correctly as a debit or credit. Furthermore, make sure that everything that's here belongs in here. Make sure for whatever reason you did not create an extra entry. Make sure what is in here, make sure that it belongs in here. Now, if you've satisfied those 3 requirements and you are still off balance, we're going to go backwards. We're going to start stepping backwards here. Area number 4 is going to say you recompute the account balances in your ledger. So now we're going to go back to the prior statement where we got the data, make sure that, again, we computed the correct numbers from there. Still haven't discovered the error, go back and make sure that you posted each entry correctly. Specifically, make sure you posted each journal entry correctly. The last, verify that each original journal entry has equal debits or credits. So now you're going to go back to the original entries and make sure you put those correctly using debits and credits and that you're in balance. Now, at that point, if you've satisfied those 6 items and you are still not in balance, I suggest that you tear up the sheet of paper.
Start all over.
Yeah.
Or give it to someone else to look at.
15-minute break. Early.
Have a glass of wine.
Have a glass of wine and start back
Calm
up.
yourself down.
Start back over. All right, so where do we go from here? Let's assume that we're in balance right now. What's our next step? We've successfully computed and recorded our trial balance. So where do these numbers go?
Income balance,
To your financial statements.
to the income statement.
Yeah, I was saying.
Because that was just like the balance. No, never mind.
All right, you were getting ready to say it kind of looked like but
yeah.
Look here, we had debits and credits on the trial balance. Your balance sheet contains what?
Your transaction.
In equity, okay.
All right, now one thing, remember the company name, and then what do we put under? We put the date. What time period will I include for my income statement? Specifically, what time period would I include for my income statement, my statement of retained earnings, and my statement of cash flows?
A month?
Mm-hmm.
Do it for the month?
It's for the month.
Or a specific time period? Same on each one.
Here's what I just heard, a month, a quarter, or a specific time period. The key word I want you to identify with those 3 statements, your income statement, your statement of retained earnings, and your statement of cash flows, are always going to be look-back statements covering a specific period of time. What about the balance sheet?
It's a specific date.
A specific date. This particular point, this is what I'm valuing my assets, my assets, liabilities, and equity. All right, I opened up this tonight with a discussion about those 4 statements and what they were. I will tell you in your presentation, you have a slide that's going to give you another explanation of each one of those 4. You're going to see an example of each one of those. I have a slide on here of each one of those. For this week's discussion, question 2, I believe, takes you outside of the textbook. And again, I direct you to Yahoo Finance, where you have to pull your favorite company.
Mm-hmm.
Okay, again, I chose to go that route based on this right here. Yes, I've got a slide that's going to show you the income statement, the balance sheet, statement of cash flows, and statement of retained earnings. But by directing you to Yahoo Finance, I got the feedback thus far that I've wanted. I've heard, wow, I didn't know this was all available. Wow, this is pretty cool. Wow, I didn't know it was so readily available. And that's a site that is rich in resources that will be able to let you see specifically with your own interest. You got to put your company in there, but it's going to allow you to go in there and look at what, you can get a good current perspective of what's going on. I forget which one of you even included the closing share price, but yes, you can go in and see what data is available to you there. All right, now I'll point out to you that both GAAP and the International Financial Reporting Standards prepare those same 4 statements.
Roscoe, go on, honey.
There's a few differences. There are a few minor differences between the presentation of those items. I include a slide for you that points out what each of those items are. Now, the last thing that I want to show, the debt ratio. Does anyone know what the debt ratio is?
Well, now I do, but I mean, I'm looking at the whiteboard, so.
It tells people they're a good risk to give you money.
From a creditor's perspective, yeah, when I loan you
too
money, but
much.
specifically, it's going to tell us what amount of assets are being financed by debt. What amount of company assets are being financed by debt? It can often be said this is a ratio of solvency. For example, a debt ratio of 0.5 and below. Let's say a debt ratio of 0.5, let's say 0.3. That might suggest that a company is not being as efficient as it could be. It could suggest that that company is not making best use of its assets. That means it would be too rich in assets and too little liabilities. However, if I had a ratio of 75% or more, what might that suggest?
Your leverage too high?
Your leverage too high. That means 75% of my assets are being leveraged through these liabilities. What that might suggest to me is I'm headed down a road of bankruptcy, especially if I have one more downturn in an economic condition that impacts my business cycle. I could be headed toward insolvency. So it kind of puts us in that perspective of where do most companies find themselves? All right, and I looked this up for us today. On average, companies operate with a debt ratio around 0.6. So US-based companies are going to operate around 0.6. All right, I'm going to say right now we've seen that creep up a little bit higher than what we might have recorded in the past. What that suggests to me is that companies are now willing to finance more of its assets using debt. Versus, if I don't finance it with debt, I could finance it through equity. I could sell, let's say I'm a publicly traded company, I could sell stock in myself to the public, could raise capital that way, or I could borrow the money through the debt markets. We see, I think, more companies are willing to take on debt than they have in the past. Why might that be?
Interest rates are low.
Interest rates are very low. There's a lot of countries right now operating in our global marketplace with negative rate treasury bonds. Or I would say negative rate government bonds. Japan today. The United States have done this in the past. Britain is threatening to do it. And what that means is you would loan your country money and we pay you 0 interest. If it goes into negative rate, you would buy a treasury bond or a government bond from Japan, purchase it for $1,000, hold it for a couple of years, and they might give you $990 back. Interest rates are very, very low right now. Our United States Treasury, a good headline read yesterday, could we go to 0 on the 10-year Treasury? Or excuse me, could we go less than 1% on the 10-year Treasury? As of yesterday, you purchased the U.S. Treasury, a 10-year note. I think we were at 1.37. We're hitting at lows. That's historic lows at 1.37. That means you give our country, you give Uncle Sam your money, and he will pay you 1.3% per year for 10 years. Now, I point out to you the cost of inflation is hovering around 2%, so you're losing, your net wealth is decreasing. Also, I want to point out to you, there are tax advantages to financing with debt. If you take on debt and you make that interest payment, right now the IRS allows you to deduct and write off that expense against your income. So it is a tax deductible expense. Whereas if you borrow using equity and you loan out cash, remember what you did right there. We said that balance sheet could be a statement of solvency. Okay, you just took equity out of the company. Companies like right now being able to write off, well, I don't want to say right now, in general, we look for those expenses that we can deduct the interest. Again, that net income is what we're going to be taxed on. All right, now I would share with you, that doesn't mean we go and load up and go overboard on debt, but we try to find that balance that is most efficient for our specific operations. But historically, we've been around 0.6. All right, now the last thing, if I break down that 0.6, I would tell you, what industry type do you think would have higher debt ratios? And which do you think would have lower?
Banks would have higher.
Okay, here, banks would have higher. Now let's look at what goes into this equation. Total liabilities divided by total assets. Which industry would have higher? And think what makes up this asset category. Which industry would have large piles of assets?
A car dealership?
Car dealerships. Let's expand that and say car manufacturers. Your manufacturing industry is going to be one that has large asset values tied to property, plant, and equipment. Your service-based, specifically your technology industries, are not going to have that same level. Meaning, let's look at Google. All right, Google currently has a debt ratio of 0.002. Well, let's say 0.02, so they're at 2%. Google does not have a need for a long assembly line and a lot of equipment compared to a Ford Motor. Ford's going to have more of their money tied up. Google's taking in more in the form of revenue, but again, we don't have revenue applied up here. So manufacturing would specifically have a higher asset value. For comparison, I looked at Avis, and we want to talk about car rental. Taylor, I brought this for you. Avis rental cars is hovering right now about 0.51, and as I said, Google is 0.02. 0.2. Correct me on that. Not 0.02, 0.2. I need my contacts. It's a long one. All right. Any questions about the slide here, about the ratio, about analyzing the transactions, or anything that we covered?
No, sir.
All right. I'm going to stop the recording.